Hello friends, welcome to my channel. In this video, we are going to discuss 12 different types of stocks which you should never buy as an investor. If you're new to the channel, please do subscribe it right now and consider joining my YouTube community where we are discussing lots of stock specific ideas and live market analysis. And don't forget to join our Telegram channel as well. Let's get started. So in the stock market, knowing what not to do is equally important as knowing what to do. So in today's video, we are going to discuss what you should not be doing while investing in the stock market. So when you're making a portfolio, as important as it is to choose multi-baggers or winning stocks, it is equally important for you to avoid the stocks which can be losers or which can be underperformers. So how could the losers impact your portfolio? Suppose a stock is of 100 rupees when you purchased it and it falls just 50%, it becomes 50 rupees. But for it to come back to your cost, it is supposed to rise 100%, not 50%, from 50 to 100 rupees. You should always remember one thing. In the stock market, protection of your capital is important. As you know, Warren Buffett said, never lose money. So for protecting your capital, there are some situations where you have to leave some opportunities also. So you shouldn't be worried that it's not important to catch each and every opportunity in the market. So the cost of losing an opportunity is much lesser than losing your capital. So for all this, what should be your approach be as an investor? You should create your own set of criteria for selecting the stocks, your own set of rules for working in the market, and you should be disciplined and patient enough to follow those rules. And something, if there is any opportunity which is coming on your way, which is not within your set of rules, you should leave those opportunities and wait patiently for those opportunities which satisfy your set of rules and your criteria of investing. So now let's begin and discuss those 12 types of stocks which you should be avoiding while investing. The first one is your favorite penny stocks. You should never buy penny stocks. Why? Because if there are penny stocks, there is a reason why they have become penny stocks. There might be huge underperformance or their business model might have failed. There could be major reasons why they have fallen from their peaks and they have become penny stocks. Why do people buy penny stocks? They are hopeful that the company might turn around the business, but it is not easy to turn around any business from the position where they are right now. And for an investor, they anticipate that there is a turnaround happening, but that not might actually become a turnaround. So in just an anticipation, you should never buy penny stocks. Another type of stock you should avoid is those winning stocks or those leading stocks of any particular sector which was just in the earlier bull run. So if there is any sector which is leading in the earlier bull run, there are stocks which are leading in the earlier bull run. If you feel that they have corrected a bit from their highs, you should not just go and buy them. Most of us feel that if they have performed well in the last decade, they will continue to perform in the next bull run. But in every bull run, the sector which is leading is different, the stocks which are leading are different. So you should avoid getting into such traps. The next one are micro caps. There are two types of micro caps. One is the newly started companies, or another one is which continue to be micro caps all throughout their life for several years. You can see there are many stocks in the market which are listed 20 years, 30 years before. But even now, if you go and see, their market cap is just 100 crores or even below that. So you should avoid such stocks because if they have not performed all these 2 decades, there is a very rare possibility that they will perform now. And why you should avoid them? Because their business model is not proven. They have literally failed. And for the new stocks, which are the companies which have just listed, if they are micro caps, you should be very careful whether the business model which they are running is a proven business model or not. Have they sold those products to a number of customers and tested whether the service which they provide is being used by hundreds or thousands of people already and they are satisfied with that or not? Because most of the startups or most of the micro caps die a natural death. After a period of time, they realize that their business is not working and they fail. So the chances of losing money in micro caps is much higher when compared to mid caps and large caps. Many a time such companies bring or create an impression on us that although they are making losses presently, they have excellent potential for future profits. But having a potential or anticipation for future is different from actually getting profits right now. So if you are investing in companies which are already into profits and growing at a decent rate, your chances of success are much higher when compared to investing in micro caps. Even if you want to invest in micro caps, there is a way of investing. If you have some confidence in the company, invest a little amount, and as and when the company keeps performing, you keep increasing your investment. So you start averaging upwards. Never be in an opinion or a mindset that in stock market you should always average downwards. Many of the legendary investors have always followed the upward averaging strategy, and they have suggested us to follow that. You should also look at the industry dynamics, whether the micro cap, the industry in which the micro cap belongs, the industry is a good industry or not, or the entire industry is becoming obsolete. So keeping these points in mind, only then you should invest in micro caps, or micro caps are totally avoid for early new investors in the stock market. The next type is the second line stocks. If you're not investing in market leaders, you're compromising in the quality of the stocks, only then you will get the stocks at cheaper valuations. So just because if you're getting stocks at cheaper valuations, you shouldn't buy them, because they are available at cheaper valuations, lower P's, because they have been underperformers. So just because they are cheaper, you shouldn't build a expectation that they will have a PE re-rating or valuation re-rating, and they will start having the same valuation as the leaders in their industry. These kind of underperformers rise lesser when the market is going up, but they fall faster when the market is going down. So this type of stocks, or buying this type of stocks, can be a key for destruction of your portfolio. So there is a complete avoid for buying second line or low quality underperformers in any particular sector. The next type of stocks you should avoid are the stocks which are in a falling trend. If they are making new and new lows every week or every day, you shouldn't be attracted towards them just because of their valuation. Lot of us are tempted to buy stocks which are at 52-week low. We are having a thought in our mind that the worst is already happened with the company, and then there can be a turnaround. But it is not the case. The 52-week low stocks continue to fall every time, and your wealth gets destructed. Lot of times we are having an expectation that there could be a V-shaped recovery in a 52-week low or a drastically fallen stock, but that may not happen. So even if you want to buy some stock which is falling, you should wait for the stock to consolidate. We should wait for a stock to bounce back. When there is a certainty, when you can see on the chart that there is a turnaround, the stock is rising, only then you should buy, and with a strict stop loss. The next stock, which type of stocks we should avoid, are excessively large market caps or overvalued stocks. Suppose there's a stock with a market cap of, let's say, 1 lakh crore, and the entire industry's business size is just 1.5 lakh crore. Then there is a very little scope that this particular stock's market cap will further increase. So you have to compare the market cap of the stock with the industry size and see whether there is a lot of scope in the industry for this stock to become larger and larger, this company to gain more and more market share or not. If at all that is already overvalued, then you should stay away from such stocks. Another way of comparing market cap is with the turnover. If at all the turnover and if at all the market cap when compared to the turnover is very high, let's say 10 times, 20 times, 100 times, then you should completely avoid such stocks, as those stocks are highly overvalued and they are about to reach a saturation point from where either they will slow down and stop growing, or they will start correcting. The next type of stocks you should avoid buying are the companies which are going into unrelated diversifications of businesses. If at all there is scope in some company's business, that company tries to go more and more deep and higher in their business. They try to either vertically integrate, increase the margins, or increase the turnover. If the company is going into unrelated diversifications, let's say some software company is going into power generation, or some construction company is going into chemicals business. So if they are going into a totally unrelated business, there is a high possibility that they may fail in that business, because every business has their own peculiarities, and the promoters should have such qualification and experience to succeed in that business, because there is competition everywhere. So if you see your stock or a company getting into unrelated diversification, then you should come out of that stock immediately. The next type of stock you should avoid is a company which is going into a number of continuous inorganic acquisitions. So if this company is going on acquiring new and new companies continuously, you should see whether the companies which they are acquiring new are having the ROCEs either equal to or more than their existing business. Suppose their present return on capital employed is 15%, and they are getting into a type of business or acquiring a new company whose ROCE is, let's say, 10%, then the margins and the return on capital employed of that business will fall and the stock will start underperforming. So you have to see whether the new acquisition will increase the return on capital employed or decrease the capital employed. You should also see whether the company is acquiring the new company from internal accruals or debt. As long as there is a limited amount of controllable debt, it is understandable. But if there is excessive debt, just for the sake of acquisition, if the company is borrowing more and more money, then you should be alarmed for that situation. So these are the companies which you should try to avoid, which have inorganic growth, too much of inorganic growth and too many acquisitions. The next type of stocks are the companies which are having very high debt. If at all the company has to grow and the company is profitable, they are generally supposed to generate money from their internal accruals. I wouldn't say that they should not borrow, but debt to a limited extent for the purpose of growth of the company is understandable, but excessive debt is too dangerous. Most of the companies which have failed in the stock market, which have closed down, have one major reason of excessive debt. So you should ensure that the company is not going for excessive debt or high equity dilution. Now, what do you mean by equity dilution? When some company needs money, the easiest way for the company to get money is by issuing shares, because there is no cost of issuing shares other than giving dividends to the shareholders and increasing their EPS. So there's no fixed cost like interest. So if the company is continuously diluting the capital by giving rights issue to existing shareholders or doing QIP, then it is a signal that the company is taking too much of cash and the company is liquidating the capital too much, and you should have an alarm in your mind. You should also keep in mind whether the growth rate of the company and the return on equity is in line. If the growth rate, the company is trying to achieve a growth rate very fast and the return on equity is not much, then there will be shortage of funds in the company, and then the company will resort to all these measures of diluting equity and taking too much of debt. Another factor you should compare is the revenue growth with the debt growth. If the revenue growth is in line with the growth in the debt, or if the revenue growth in the initial couple of years is slow, but very soon the growth is catching up and the purpose for which the debt was borrowed is fulfilled and the revenue is growing, then it is understandable. Otherwise, high debt companies are a complete avoid. Another type of companies which you should avoid unless you are experienced and knowledgeable in the market are the cyclicals. Cyclicals are the companies which work, the businesses which work in cycles, like commodity companies. So it is important when you are buying a cyclical that you get in to those stocks in the beginning of the cycle. If at all you see that the stock is rising and you end up buying it at the top of the cycle after the company stock has risen, then there is a high possibility that after you buy, the stock will start falling. So unless you have the knowledge of identifying a cycle, you should avoid cyclical stocks. The next type of stock you should avoid are the companies which are doing too much of show off. They continuously have press conferences, they keep announcing different expansion plans, they keep announcing different guidances which may or may not sound so practical. You should stay away from such companies because those companies have too much of pressure in performing them, and as soon as that news comes, the future growth or future benefit is priced already into the stock price. So after that, if you buy, then it is of no use. And if at all the company fails to meet that expectation of the shareholders, the stock price falls drastically. So if you see such companies which are having too much of guidances, which are doing too much of show off, you should avoid such companies. The last type of companies which you should avoid are the companies which are doing window dressing to their financials. Now, what is window dressing? You are projecting a different picture of the financials position of the company than it is actually is. How can you identify window dressing? If there are profits in the company but negative cash flows, if the company's stock is not moving and the inventory turnover ratio is falling, if the receivables are continuously rising, that means the company is having sales but they are not receiving money for the goods or services rendered. If the debt is rising, if the equity is diluted for requirement of funds, if the margins of the business are falling, if the company is showing profits but the profits are because of other incomes in the financials and not from the regular business activity, or sometimes there are profits from exceptional items like sale of fixed assets, and in any particular year the company is showing higher profits, but those are exceptional items which will not happen every year. So when you observe these kind of instances, those company stocks are a complete avoid and you should stay away from those stocks. So what you should do, you should avoid these 12 types of stocks. You should make a list of things which you should not buy from the stock market. Until now you have made a list of what you should buy. Now you should make a list of what you should not buy to succeed in the market. Don't try to capture each and every opportunity which comes in the stock market, and it is always important to work within your circle of competence, to invest in businesses which you understand, to invest in companies of which you have complete knowledge and for which the information is available. Don't invest in anticipation, don't invest in hope. Do your research and analysis in a proper way. Avoid these 12 stocks to succeed in the market. So which point among the 12 struck you the most? I would love to hear from you. Please share that point which has struck you the most in the comments below. Thank you for watching this video. This is a new type of video I have brought. I hope you like this concept. Thank you for watching. Do subscribe to the channel, join the YouTube community, do follow me on Telegram, and have a wonderful, wonderful day.